Hi, this is Tim from Trading Strategy Guides. I've got a great cup of coffee right here and another great trend following strategy to talk about. It uses the Keltner channels and pretty easy to follow. But first, let me find out if you guys can hear me, because I would hate to talk through half this webinar without anybody hearing me. And yes, that's happened to me before. If you guys would let me know if you can hear me and if you can see my title screen up here, this title screen here, I'd appreciate it. Want to make sure you guys stick around until the end, because we'll have a question and answer session. Thank you. Thanks, Jay. And drone graphics, awesome. Sergey, Jay, appreciate it. Yeah, we'll have a question and answer session after the training, and I'll take your questions on anything related to trading. Go ahead and post them in the chat when you come up with them, and I may not address them right away, but I'll definitely see them, and we'll get to them after the training is done. And then after the questions, I'll reveal another one of my trading maxims. Just a reminder, if you're watching the recording of this session, you can click on the gear in the lower right and speed the video up and save yourself some time. Of course, if you're watching live, you get the benefit of my immense wit and humor with which you can interact. And no, there's no heckling from the peanut gallery allowed. Okay, let's dive into the Keltner channel. Keltner channel is an envelope type indicator that overlays on the main chart. You probably feel familiar with the Bollinger Bands here. Keltner channels are similar, but they just use different indicators to make their calculation. Bollinger Bands are based on the standard deviation. The Keltner channels are based on the average true range, and you guys know how much I love the ATR. I think the ATR is one of the best volatility indicators. I also use it to find my stop losses and targets. So one thing I like about the Keltner channel is it's a lot smoother than the Bollinger Bands. I've used the Bollinger Bands for trading, and the standard deviation varies a lot in this case, but the ATR is a little bit smoother. In case you care, this is the math that goes into the Keltner channels. The middle band is a 20-period EMA, exponential moving average. The upper band is that EMA plus the ATR times the multiplier. And the lower band is, of course, the 20 EMA minus the ATR times the multiplier. And you can set the multiplier in the indicator settings for the purposes of that I use the Keltner channels. I just use a multiplier of 1. Okay, here's kind of what I like about the Keltner channel. This is an example of what a Keltner channel looks like in a strong trend. Price hugs the edge of it, sometimes pushes below it in the case of a downtrend, or above it in the case of an uptrend. But it's, obviously, if you're just looking at the price action here, you can see that it's in a downtrend. What this does, though, is it gives you a way to measure the downtrend with respect to the candles that came before. In a ranging market, kind of the same. Obviously, you can just look at the candles and see a ranging market, but the Keltner channel gives you an idea of, it gives you a measurement to look at. As the channel gets narrower, you know that the volatility is reducing, or the average candle length is reducing. And so you can tell a lot better that the price action is winding up and consolidating. Okay. It's also nice for measuring pullbacks. See, we've got a nice trend here where the price action is hugging the top channel, top band, and we can measure pullbacks or pullbacks toward the 20 EMA. So the Keltner channel is just good for helping you judge market conditions. Now, like I say, you don't have to have the Keltner channel to judge market conditions, but the nice thing about indicators in general is it gives you a relative location to help you see exactly what the market is doing, not just generally. So Trading Strategy Guides has 3 great strategies that use the Keltner channels. I'm only going to talk about one of them today, but I'm going to show you the other 2 real quickly before we go on to the third. The other 2 are likely to be subjects of future videos. It depends on on what y'all think. Let me know if you want to look at the other strategies in detail in the future. I'll post a link below to the blog at Trading Strategy Guys website where all these strategies are explained in detail. But the first one we're going to look at here is the breakout strategy. Strategy pairs the Keltner channel and the ADX to find consolidation breakout opportunities. So the Keltner channel is good at finding these locations, finding these spots of consolidation, but sometimes you need to use other indicators to help you time your entries. So in this case, the ADX helps time the entries on these breakouts. The next strategy that we're not going to talk about this morning is the ranging markets. And the strategy with the ranging markets uses the RSI combined with the Keltner channel to help you trade in ranging markets. Just be sure you've got a big enough ranging market to trade in. If you're only trading in a ranging market on a 15-minute chart, it's probably not enough pips in that to actually have success. Okay, and lastly, we'll look at the pullbacks, trading pullbacks and strong trends. I'm particularly partial to trend following strategies myself. I've used reversal strategies in the past, and while reversal strategies are great, they require so much focus, and I'm just not good at focus. I have friends who can stare at the charts without blinking for 24 hours at a time. I can do it for maybe 24 seconds on a good day. Now, I'm not ADHD or anything. I don't know. I guess I've spent my life practicing moving from activity to activity. And when something is a bit slow, I'll move on to something else that's important or that I consider important. So, in the case of watching charts, I'll watch charts for about 15 seconds, but if they're not moving, I'll probably be watching cat videos or something, something really, really important. So anyway, we're going to combine the Keltner channel with the Stochastic Rsi indicator to trade pullbacks on strong trends. So remember, when the price hugs the top band in this case, or the bottom band in the case of a bearish trend, you've got a strong trend. So the first thing you want to look for is your trend. And the way I trade, that's always the first thing you look for, is a trend. Sometimes it's not a very big trend. Sometimes it's not even obviously a trend. but you got price moving in one direction for a little while. Notice that price once in a while pulls back to the 20 period EMA. And this is one of those situations where you got to remember that a line is never just a line, it's always a zone. You know, I think that's one of my trading maxims. If it's not, it should be, because I say it all the time. A line is never just a line, and that was something I had wrong when I was early in trading, when I was a young trader. I wasn't young, but I was a beginning trader. A line is just kind of an idea in trading. Price, when I say pull back to the 20, it may not even touch the 20, but it comes near it, or it pushes through it, or it just exactly touches it and bounces off, which is kind of satisfying, but it doesn't happen often. Most of the time it pushes through or just comes up close to it. And the reason is traders have got orders on both sides of this. Some traders are saying, okay, well, if this gets within 5 pips of this 20, I'm going to go long. Or some of them will say, well, it almost invariably pushes through the line, so I'm going to put in an order 5 pips on the other side of the line to go long. So that's the reason why a line is never just a line. The 20 EMA essentially represents a place where the bounce could, where a bounce could occur, and the strong trend resume. So think of it that way, okay? And the thing is, you don't need to know the exact turning point of price to be a successful trader. That was something else I thought. You know, I'd be in a trading room with somebody, and this was in the, you know, this was 2000. I started in 2004. So 2005, 2006, for several years in there, I would always be asking, well, what's your stop loss? And I wanted to know to the pip what the stop loss was. And it took me a while to get that, the exact point. You know, the trainer, the trader was not a magician. He didn't really know any more about the market than I did. Well, he knew a lot about the market, but he didn't really know exactly the point where this was going to turn. His stop loss was just as likely to be taken out as my stop loss. So it's not about getting it down to the exact point. It's more about needing an edge that will allow you to win more than you lose. And sometimes that edge involves a smaller take profit than your stop loss, because then it's less likely that the stop loss will be taken out before the take profit is hit. But of course, then you've got to win 60, 70% to be profitable. So, but there's nothing wrong with that. If you've got a strategy that works that way, that's great. If you've got a strategy where you want to double your take profit, so that you, so your stop loss is 10 pips and your take profit is 20 pips, that's great too. If the strategy works, you've got to back test it to find out if the strategy works, and then forward test it before you put any real money on it. Okay. Okay, so we're going to use the Stochastic Rsi here to help time the entries. In this example here, we placed our market buy order when price pulls back to the 20, and the Stochastic Rsi crosses back out of the oversold spot. Okay, so in this case, the order is probably a couple of pips up, right in, maybe on this candle right here. I'm a proponent of waiting for candle closes to trade, or at least to get into trades. I will, however, close one out when it hits my target, even if it's, you know, not a candle close. But typically I'll trade targeting the ATR and take half off at that point and then follow stops, or use some other kind of indicator to get me out, later on after the price, give it a chance to run a little bit. So in this case, you can either put your stop loss below the lower Keltner band down in here, or like I say, you can use my favorite management technique, and that's placing your stop loss at the ATR times 1.5 below your entry. Okay, well, that's the Keltner strategy. I'm going to take a look at a couple of live examples now. Here we go. Now, I just was looking at this chart, and this is just, I did not cherry pick anything here. Well, obviously I cherry picked some trades, but not every one of them is a winner. And I don't believe in showing you just winners, because you need to know what a loser looks like too. So here's an example of a pullback. Here's a strong trend pullback that touches the 20, and the stochastic RSI is in the oversold territory, and it crosses over right here at this candle. So the entry would be on the close of this candle right here, a long entry. And I used my favorite 1 ATR target, 1.5 ATR stop loss. And that would have worked out very nicely. We would have been in profit right here. The second half, depends on how you followed stops here. I probably would have caught this move right here, because my stop loss would have been down here near break even, break even plus 1 or 2. And so my second half could likely, I probably would have gotten out on this pullback in here somewhere. So that's potentially 400 some pips. So that would have worked out nicely for me. Now another trend up here, pullback to the 20. Now this pullback crossed over right on this candle, and it just barely crossed over and then dropped again. So this was kind of a head fakey kind of thing here. It may or may not have hit this stop. Sometimes it's hard to tell when you're back testing and you're looking at charts historically. Sometimes it's hard to tell whether it actually would have hit the stop. I think it probably would have stopped out here. The thing is, it hit the other side of the Keltner channel. It pushed through the Keltner channel in this case, so it's likely, even if it didn't stop out, that I might have closed it. Okay? You got to be okay with that. If I didn't close it, if it didn't get stopped out, hit the target, but it didn't go much beyond that, and I probably would have been out on the second half break even over here somewhere. But I'm more likely inclined to believe that this actually stopped out. So now remember, when you size your trade, take into account the stop loss, use a position size calculator, like myfxbook.com has one, and don't set your risk over a few percent. Somebody asked me why 2%. Well, why not? 1%, 3%, it doesn't matter. It's not an exact science. Just be consistent. Okay. Here's a really, really nice push down, came outside of the Keltner channel. Did not really pull back enough. I believe in zones, but this is really not that close to the 20 yet. So here's another opportunity where it came to a nice pullback, but then the stochastic RSI never dropped below overbought until it was way up here. And that was after it made a nice uptrend on the outside of the channel. So as soon as it started doing this, I would have taken this potential order off the table. Okay. Now, once it gets into here, the strong trend is gone. I mean, it's whipping back and forth, and we're getting into a consolidation right in here. Okay. Now this consolidation is pushing way below, so it's kind of a down consolidation, and you can see that's exactly what's happening. But it's whipping back and forth a lot here, so I would move on. This is a daily chart of the Euro New Zealand. I like the Euro New Zealand. I don't know why. It's whippy, but not whippy like the pound New Zealand. So there's a lot of volatility. It moves around a lot, and so I trade at every opportunity I get. Okay, that's all the examples I've got set up. So does anybody have any questions, comments, opposing viewpoints? Except you're not allowed to have opposing viewpoints. Just kidding. Ozzy, who's the win the game, John Bollinger or Mr. Keltner? Yes, I'm always in favor of the trend, and like I say, it's about focus. I think there are people who make a lot of money trading reversals, and the cool thing is, I know that when I put up a chart, and if you guys have ever watched any of my videos or attended any of my sessions, you know that. Let me just find some charts here to throw up and talk about. Okay. I've been talking about Boeing. Let me just say this really quick. I've been talking about Boeing now for a couple of weeks, and apparently somebody, I didn't get a chance to read it. I only saw the headline, but apparently the stockholders are suing Boeing about the 737 MAX jet. There's been a couple of crashes of the 737 MAX, and so the stockholders are suing Boeing over that, and that's new news. I'm kind of interested to see how the market opens here in a few minutes on Boeing. But as you guys know, I like to go back to the weekly chart and put in support and resistance levels. And really, these lines are just based on historical turning points. So anytime you see a significant turning point like this right here, that's definitely a level. Anytime you see several places where price has been rejected or price has turned, that's a level. This one is kind of a wideish zone because you could, this is the S&P 500, by the way. You can see where price was rejected here around 2798 or 2800. And here's a little bit higher point where price is pushed through, but it's hit the 2812-ish area. So here's another level, 2550 up through about 2570. And just look, especially if you have real big rejection wicks here. So I look at the place where the wicks and the bodies are all kind of together. And here's a spot right here because we got candle bodies here that are reacting to this level, a wick here, two wicks here, a candle body, a wick, and some more candle bodies. So this is definitely 2590-ish is a level. And I had somebody ask me, well, how many pips on either side or points on either side of that? And I say, well, it depends on the zone. Okay, some zones are huge, some zones are small. This zone is huge in this case. And all you have to do is just look at the price action to see See where that is. But what I'm saying here is when you identify a zone like this, if you're a reversal trader, you anticipate price to hit this zone and reverse a little bit. You have to be very focused to do this because it's not going to go for long against the trend. It's just going to hit it, particularly if it's a strong trend going into it. Here's an example. It's a strong trend going into this level, and it pulled back a little bit. How much did it pull back? 20, about $30. So it pulled back a little bit, but how long did it pull back? Well, this is a weekly chart, so it pulled back for quite a while. But if I were looking at an hourly chart and it pulled back a little bit, then this would be, less than an hour. If I was trading on a 5-minute chart, then, you get what I'm saying. It's likely to bounce. And in this case, it bounced for 3 weeks before it broke through. So, it doesn't hurt to find a good level and keep shorting it and taking profit and short and take profit and so on. But I wouldn't try to hold anything looking for a long run. But that's what I like about trend trading. So instead of looking at this as a place where price is going to bounce, I look at it as a place where price is going to break through and go a long ways. And so I put my orders in place here, looking for the breakthrough instead of the bounce. So that's why I like trend. Drone graphics. I love your droneo graphics. That's cool. I'm a drone pilot, so yeah, I love it. Amateur, hardcore amateur here. Anyway, the ATR, you can put an ATR indicator on your chart. In this case, I used the 14 period ATR, and then the ATR. If you're looking at if you're back testing and you want to find out the ATR at that point, just position your cursor right on the line, and there's your ATR 7540, and so on. So now the ATR, of course, is the average true range, and basically what that does is it takes the high of the candle, subtracts the low of the candle, and then averages that number over 14 candles. So it's a really good measurement of volatility. In this case, volatility had reduced to 31.89 right here in late December, and then it popped first few months of the year and so on. So anytime I see, you guys will see me when I analyze charts, I like to look at the volume. In this case, we got a lot of disinterest. People just really don't care too much about this. So it's pushing down. Volatility was pushing down up through the beginning of the year here. So a lot of disinterest. So when you have that kind of situation, when you suddenly get interest again, and price pushing up above this line, pushing up above the average, and the volatility popping up like this, then start paying attention, because somebody is interested in this thing now. So yeah, this is I was looking. I actually almost never look at monthly charts. Actually, this is the monthly chart already positioned. Well, it's not already positioned. Let me fix this. This is the only thing that bugs me about TradingView charts, is that they don't stay positioned the way I want them sometimes. Anyway, you can see that since back here, way back in 2016, October or so, this has just been declining. Okay, so this trend, and again, I point out this is a monthly chart. Let me get it all the way back to the back. No, this is not a monthly chart. This is a weekly chart. This is a monthly chart. I wondered why I was having to compress that so much. Okay, bear with me while I position all this. Okay. All right, here's the monthly chart. During the course of this whole uptrend right here, interest has been waning. It's been dropping off. We got a little bit of more interest in here. You see there's a little bit of a hiccup in the trend. And so the volume popped up a little bit here. Volatility had been waning, and then the volatility popped up a little bit right in there. So obviously, this trend for the last 10 years, 2009, in the S&P 500 is getting old. It's long in the tooth. And a lot of analysts are saying, well, is this going to go for another 10 years or what? I don't think so. I do not think so, because people are getting bored with this. I don't know. The volatility is kind of the same. We got a little pop in the volatility, but that's up here where people started thinking, push this down, push it down. We're going to go down here. So these big red bearish candles right here are what caused the volatility to pop. And I don't know, but there's still some people that want to keep pushing this thing up. So this is a knife fight. Even on a monthly chart, it's a knife fight. And drill down to the daily, and I pointed out that even the trend here over the last over this year, since December, is kind of rolling over. This was a really hard trend, and then it pulled back, and then it pulled back some more and broke that original trend line, and now it broke the trend line here, and then it broke another trend line here, and now this trend line is starting to be attacked. So I think this is rolling over. Waning interest, volatility is dropping off. So yeah, watch stocks. I don't think this 10-year bull market we've had, I don't think it's going to last. But that's just me, and it's all opinion, and I have absolutely no way of knowing for sure. So I'm not magical. Analysts won't tell you that. I'm a trader. That's the reason why I'll tell you that. I'm a trader who does analysis, not an analyst who doesn't trade. So, does anybody else have any more questions? Drone graphics, did I cover you on that ATR thing? So all of a sudden my phone is blowing up back here. In case you hear that, I apologize for that. Okay, if there are no more questions, if you guys think of a question later, don't hesitate to put it on the video, and I will do my best to cover it. Time for the maxim, number 21. I'm going to be a little philosophical here. Number 21, you may need to take a greater risk to go where you need to go. Everything of value in life comes with a risk. The greater the value, the greater the risk. And this applies in all areas of our lives, not just trading. I am continually amazed at how everything I do overlaps, and things I learn in one area, like I'm an avid CrossFitter, so I learn things in there that apply everywhere, that apply to trading. I learn things in trading that apply to drone piloting. I mean, everything applies across everywhere if you look for the application. So sometimes you have to take a greater risk. Businesses risk more money to make more money. We risk our pride and security every time we reach out to other people. We risk being rejected. We risk being hurt physically, emotionally, whatever. But you will never build a relationship without that risk. You'll never build a business without risk. You will never be a successful trader without risk. I attended a trading conference after I kind of had a handle on what I was doing, say '09 or 2010. 2009, I met Casey, and Casey is the one who helped me get my head screwed on straight. He's my trading coach now, and Casey Stubbs from Trading Strategy Guides, and he's I've been friends with him since 2009, and he helped me get that straightened out. But I was just attending a conference of one of these trading groups that have these huge, expensive trading packages, and so they asked initially if anybody in the group had trading experience. It was a pretty good size seminar, maybe 50, 60 people there. And I raised my hand because I had 6-7 years of trading experience and I understood some things. So all of a sudden at the during the break, everybody was swarming around me and asking me questions. And I didn't want to derail what they were saying there. I mean, that wasn't my place, whether I agreed with them or not. That was their seminar, and I wasn't going to derail anything they were saying. So I'm telling some of these people that you have to, that taking losses is part of your job. And one lady said, "Oh no, I could never take a loss." And I just had to be honest with her. I said, "Well, if you don't do that, you're never going to be a successful trader." So that's my story, and I'm sticking to it. Okay. You guys made it right to the end. I appreciate it. Having said all that, I'm going to risk asking you to click the thumbs up below if this video has helped you in any way. And I appreciate you subscribing and hitting that bell. You guys have a great day, and I'll see you next time.